You clicked because you have money sitting in the bank. Maybe it is your whole life savings. Maybe it is just a buffer for a rainy day. And somewhere in the back of your mind, a voice keeps whispering, is this safe, or is this the very thing that could quietly cut my pension? Here is the truth. There is an amount of money in your bank account that can trigger a rule most pensioners have never heard of, and it can shrink your age pension without you spending a single dollar wrong. I found this out the hard way, sitting at my kitchen table in Adelaide with a Centrelink letter I could not make sense of. So today I am going to show you the exact figure that matters, why the tax office is paying closer attention in 2026, and the simple step you can take this week to protect every dollar you are owed. And before you tell yourself this does not apply to you because you do not have much saved, stay with me, because the smaller your savings, the more each dollar of pension matters, and this rule hits you too. Let me start with the thing nobody explains properly, because once you understand it, everything else makes sense. The money in your bank account is not judged by what it actually earns. It is judged by what the government pretends it earns. That word matters. Pretends. There is a rule called Deeming, and it is the quiet engine underneath your whole pension. Here is how it works. Centrelink does not care that your bank is paying you almost nothing in interest. They do not look at your real statement. Instead, they assume they deem that your savings are earning a set rate, and they count that pretend income against your pension under the income test. Even if your money is sitting dead in an account earning next to nothing, the system treats it as if it is working hard and paying you a return. Now here is where the exact numbers come in, and I want you to write these down, or at least remember them. For a single person, the first $62,600 of your financial assets is deemed to earn a low rate. For a couple, that lower threshold is $103,800 combined. Below those lines, the government assumes your money earns 0.25%. That is the gentle rate. That is the one that barely touches you. But every dollar above that line is treated completely differently. Once you cross that threshold, the money on top is deemed to earn 2.25%. That is 9 times higher. And that higher pretend income is what starts eating into your pension, fortnight after fortnight, whether or not your bank is actually paying you anything close to it. So the reason the thumbnail said there is an amount you should never carelessly leave sitting in the bank is this. It is not that a big balance is illegal. It is that a big balance sitting in a plain savings account can be deemed to earn far more than it really does, and that phantom income can quietly reduce the payment you rely on. Now here is the part that should make you sit up. For years, those deeming rates were frozen. The government held them steady at 0.25% and 2.25%, and that freeze was locked in place all the way through to the 30th of June, 2025. That freeze protected pensioners. It kept the pretend income low. But a freeze is a temporary thing. A freeze, by its very nature, ends. And that is exactly why 2026 is the year I want you watching the calendar, because the shield that has been quietly protecting your pension is the thing most people have completely forgotten is even there. So let me be clear about what that means for you, so you do not spend the next 5 minutes in a panic. Understanding deeming is not bad news. It is power, because once you know your savings are being judged on a pretend rate, you can start making choices that keep you on the right side of that line. And I am going to walk you through every one of them before we are done. But first, I need to tell you who benefits when you do not understand this, because that is where this stops being an accident and starts looking like a system that is happy to keep you in the dark. Think about it for a moment. When the deeming rate goes up, who wins? Not you. When your money is deemed to earn more than it really does, your income on paper rises, and when your income on paper rises, your pension falls. The government pays out less. That is the whole quiet arithmetic of it. A rate most pensioners have never heard of, adjusted by a decision most pensioners never see, and the result is a smaller payment landing in your account. And here is the part that really got under my skin. The deeming rate is not voted on in a big public debate. It is set by the Minister for Social Services, under the powers written into the Social Security Act of 1991. One decision, one signature, and the pretend income of millions of pensioners shifts overnight. There is no letter that arrives explaining it in plain English. There is no phone call. You find out when your payment changes, and you are left squinting at a statement trying to work out what happened. I remember the first time I felt that cold drop in my stomach. I had done everything right. I had saved carefully my whole working life. I had a modest balance set aside because I did not want to be a burden on anyone. And I opened a Centrelink letter that told me my income had gone up. I had not earned a cent more. My bank was paying me a pittance. But on paper, according to the Deeming rule, I was suddenly richer, and my pension was trimmed to match a return I was never actually receiving. That is the trap. It punishes the careful. It punishes the person who kept their money safe in the bank instead of chasing risk. The very thing you were told to do, save, be responsible, keep a buffer, is the thing that can quietly cost you. Therefore, the question is not whether you have savings. The question is whether your savings are sitting in a way that the system can use against you. And that brings me to the second player watching your account, because it is not just Centrelink anymore. It is the tax office. And in 2026, the tax office is watching more closely than it ever has. Here is something most pensioners do not realize. Your bank does not keep your interest a secret. Every year, your bank reports the interest you earn straight to the Australian Taxation Office. Every account, every dollar of interest, it is handed over automatically, matched to your tax file number, without you lifting a finger. The tax office already knows what your savings earned before you have even thought about it. And the Tax Office and Services Australia share information. This is not a rumor. It is a formal data matching arrangement. The systems talk to each other. So when your bank tells the tax office you earned a certain amount of interest, and that figure does not line up with what Centrelink has on record for your assets, that mismatch can raise a flag. A flag can turn into a review. A review can turn into a letter asking you to explain, or worse, a debt notice demanding money back. This is the machinery that has been built quietly in the background while everyone was looking the other way. Your money leaves a trail. Interest reported here. Assets recorded there. Balances updated somewhere else. And in 2026, with the systems more connected than ever, the gap between what you told them and what the data shows is exactly what gets picked up. Now, I do not want you to hear that and feel hunted, because that is not the point. The honest pensioner has nothing to fear from data matching. The person who gets caught out is almost always the person who simply did not know they were supposed to update something. That is the real danger here, not fraud, forgetfulness, not dishonesty, just not knowing the rules changed under your feet. So let me give you the first concrete protection right now, and it costs you nothing. Your job is to make sure the balance Centrelink has on record for your bank accounts is actually current. Most people set it once, years ago, and never touch it again. But your balance moves, you spend, you get a bill, you help a grandchild. And if Centrelink is still working off an old higher figure, you could be getting less pension than you are entitled to right now, today, this fortnight. You can update your financial details through your MyGov account linked to Centrelink, or by calling the Older Australians line at Services Australia. If your savings have gone down since you last told them, updating that figure can actually increase your pension. Read that again. Telling them the truth can put money back in your pocket. Most people never do it because they assume it only ever works against them. It does not. But here is the layer underneath that, and it is the part that catches people who think they are being clever. Some folks hear all this and think, right, I will just pull the money out. I will take it out in cash and keep it at home, out of sight, and then nobody can deem it and nobody can track it. And I understand the instinct. After a lifetime of being watched and measured, the idea of holding your own money in your own hand feels safe. But this is where you need to be careful, because there is another watcher in the room, and its name is AUSTRAC. That is the financial intelligence agency that monitors large cash movements. And that is exactly the kind of detail that made me start writing all of this down properly, because a video can only hold so much before it turns into a lecture. So I put everything I have dug up into 3 books of my own: the Deeming thresholds, the letters Centrelink actually sends, the forms nobody mentions, the concession accounts, the senior's health card, the binding death nomination that stops a bank account freezing when you die. No jargon, no wealth building nonsense, no advisor and no lawyer needed. Every step in there is free and can be done this week at your kitchen table, the same table where I first sat with a letter I could not understand. If what you are learning right now is helping you, this is that same help laid out in full, with the cases and the templates you can copy word for word. To get it, scan the QR code right there on your screen, link in the description, pinned comment. The books are waiting there for you. Now, back to that watcher in the room, because you need to know exactly when the bank is obliged to report you. When you withdraw or deposit $10,000 or more in cash, the bank is legally required to report that transaction. You do not get a say in it. The report goes off automatically. And large unexplained cash movements are exactly the kind of thing that draws attention rather than avoiding it. And it does not even help you with Centrelink, because cash you are holding at home is still an asset. It still counts. It is still deemed. Hiding it under the mattress does not make it disappear from the assets test. It just means that if it is ever discovered you did not declare it, you are now in a far worse position than if you had simply left it in the bank and managed it properly. Therefore, the answer was never to hide your money. The answer is to structure it so the pretend income the system assigns to it is as low as it can honestly be. That is legal, that is smart, and that is exactly what the people who understand these rules quietly do every single year. Now, this is the point where I need to speak directly to the person who has been listening to all of this and thinking, none of this is me. I am not wealthy. I do not have big savings. I am barely getting by. This is for people with money, not for me. Please, do not switch off, because you are the person this hits hardest. And here is why. When you are living on the full-age pension or close to it, every single dollar counts. You feel it. A small cut to your fortnightly payment is not an inconvenience. It is the difference between covering the power bill and putting it off another month. The wealthy pensioner losing a bit of pension barely notices. You notice everything. So a rule that quietly trims your payment based on pretend income is not a small print problem for you. It is your grocery money. And here is the part that should make you lean in. If you have modest savings, you are almost certainly sitting below or near that lower deeming threshold, the $62,600 for a single or the $103,800 for a couple, which means the low rate should apply to most or all of your money. But if Centrelink has an old, wrong, higher figure on file for you, you might be getting deemed at the higher amount for money you no longer even have. You could be losing pension right now for savings that are already gone. So here is your concrete step, and you can do it this week without an advisor and without paying anybody a cent. Get your most recent bank statements. Write down the actual current balance of every account you hold. Then log into MyGov, go to your Centrelink details, and check what figure they have recorded against those accounts. If their number is higher than your real number, update it. If you are not comfortable online, ring the older Australians line, and a real person will do it with you over the phone. That one action, making sure the truth on their system matches the truth in your account, can protect or even lift your payment. And it takes the power back. You are no longer waiting for a letter to tell you what they decided. You are the one telling them. There is one more thing for the person who thinks they are safe because they own their home and have very little in the bank. Owning your home takes you off one part of the assets test, yes, but it does not touch the income test, and deeming lives in the income test. So even a homeowner with a small nest egg needs to know exactly where that money sits and how it is being counted. The house does not protect the savings. Nothing protects the savings except knowing the rules. And now, because you have stayed with me this far, I am going to give you the part that most people never get told. Clearly the step that turns all of this fear into control. There is a way to legally reduce the amount of your money that gets deemed at the higher rate, and it comes down to understanding one thing the system never advertises. Not all of your money has to sit in a plain bank account where it is fully counted and fully deemed. There are legitimate ways to hold value that are treated differently under the rules, and knowing them is the difference between a shrinking pension and a protected one. Let me give you the ones that are real, simple, and hard to find explained plainly. First, the work bonus. This is one of the most underused entitlements in the entire system, and it stunned me when I finally understood it. If you or your partner do any paid work at all, even a few hours, even casual, even seasonal, the first $300 of employment income each fortnight is not counted under the income test at all. And it gets better. If you do not use all of it, the unused amount builds up in a work bonus balance that can grow all the way up to $11,800. That stored up bonus means you can do a burst of paid work or a seasonal job and shield a large chunk of that income from reducing your pension. Most pensioners have never heard of it. It is sitting there, waiting, and almost nobody claims the full benefit. Second, the gifting rules used properly and honestly, not to hide money, but to genuinely reduce assets you were going to pass on anyway. You are allowed to give away up to $10,000 in a single financial year and up to $30,000 over any 5-year period without it counting against you. Anything above those limits gets treated as though you still have it. They call it a deprived asset for 5 years. So if you were always planning to help your children or grandchildren, doing it within these limits and keeping a written record of every gift with the date and amount is completely legitimate, and it reduces the pool of money that gets deemed. Third, and this is the one I wish someone had told me at that kitchen table, you have the right to ask Centrelink to reassess your situation whenever your circumstances change. You do not have to wait for their annual review. You do not have to wait for a letter. If deeming rates change in 2026, if your balance drops, if you spend down savings on a car or a repair or a medical cost, you can request an update straight away and have your pension recalculated. The system is built to make you feel passive, like you just receive whatever they decide. You are not passive. You can trigger a review yourself, and when your assets have fallen, that review works in your favor. And here is the piece that ties it all together, the thing that moves you from worried to in control. The whole deeming system, the thresholds, the rates, the freeze that runs to the 30th of June, 2025, all of it is set out in the Social Security Act of 1991 and administered by Services Australia. It is public. It is knowable. The only reason it feels like a secret is that nobody sits you down and explains it in plain words. The rule was quietly shaped. Most people never understood it, but you do now. So, this week, do 3 things. Check the balance Centrelink has on file against your real balance and correct it if it is wrong. Find out whether you or your partner qualify for the work bonus and start using it if there is any paid work in your life. And if your savings sit above that lower deeming threshold, sit down and look at whether some of that money would be better placed somewhere that the rules treat more kindly. And if it is a large sum, get 1 session with a Centrelink Financial Information Service Officer, which is a free service, not a paid advisor, run by Services Australia itself. That free service is the last hidden gem I want to leave you with, the Financial Information Service. It costs nothing. The officers do not sell you anything. They will sit with you and explain exactly how your own money is being assessed and what you can legally do about it. Almost nobody knows it exists. It is one of the few genuinely useful things the system offers, and it is buried so deep most pensioners go their whole retirement without ever hearing the name. Let me bring this all the way back to where we started, at that kitchen table, with a letter I could not understand and a pension I did not know how to protect. The difference between the person I was that day and the person I am now is not money. It is knowing. Knowing that pretend income is a thing. Knowing where the threshold sits. Knowing that I can update my own details, claim my own bonuses, and ask for my own reassessment without waiting for anyone's permission. That is what you have now too. You did not just learn about a threat today. You took back control of something that was quietly slipping away from you while nobody explained the rules. The money you saved, the pension you earned, the buffer you built, you can protect it, and now you know exactly how. You are the kind of person who refuses to be caught out by a rule that was changed with a single signature and never explained to your face. You read the fine print, or you find the friend who does. That is not fear. That is dignity. That is looking after yourself and the people around you. So here is what I want you to do for me. Tell me in the comments, did you know your bank interest is reported straight to the tax office every single year, matched to your tax file number before you even see it? Be honest. I want to know how many of you were told this before today. And while you are there, tell me which part of the country you are watching from, because I read every one of these and I want to know where in Australia this reached. If this helped you, come and stand with the rest of us who look out for each other, who refuse to be blindsided, who share the warning before it costs someone their grocery money. That is what this is. A group of Australians watching the calendar so none of us gets caught alone. And keep an eye out for the next one. because I have been digging into something just as quiet a change to the way the family home and the sale of it can affect your pension for the full year after you downsize, and there is a 2-year window most people misunderstand completely. I will show you exactly how to protect yourself before that clock runs out. Watch for it. I will see you there. Now, this video showed you how deeming works, but inside the pension watch, I take it further, the deeming proof plan, right where this video stopped. In there, you can ask me your own question, and a real person, me, answers you myself. You won't be doing this alone. Just point your phone's camera at the code on the screen, and you can cancel any time with one click. Now, here's something just as important. If you pass away, your bank account can freeze, leaving your family stuck. But there's one free form that stops this from happening. Let me show you how, right here.